Let me begin by saying, why on earth have you invited someone who's known as a macro strategist to talk at a value conference? And that's because today I want to talk about something called the capital cycle. I hope everybody listening to this is familiar with the capital cycle, because I think it's the principle of value investing. And I want to relate it to the situation with the existing monetary policy. I hope that this explains some of the issues that have been around value investing over the last several years. But more importantly than that, I think we're living through a monetary revolution in the way that monetary policy is run. And therefore, that the principles of value investing will once again rise to the top of the pile as a form of investment because of this structural change in the way this system works. The principle of capital investing is best expounded from a top-down perspective by Keynes. Again, that's the second time we've mentioned Keynes this morning. For those of you who know it as value investors, you will know it from the work of Marathon Asset Management, but particularly two books that were put together by my friend Edward Chancellor using the various papers written by Marathon Asset Management. They are called Capital Account and also Capital Returns. But here is the capital cycle as proposed by Lord Keynes. And what Keynes is saying here is that the capital cycle and the valuation of equities is driven by the supply of financial capital. And when assets are very cheap on the stock market, financial capital will be directed to creating more of them, because that's the arbitrage opportunity, buying these cheap assets on the stock market. And when they're very expensive, financial capital will not buy the listed stocks, but it will actually create the corporate capital, because the market will value that corporate capital rather highly. So Keynes is known as a value investor, but obviously known as one of the great macro investors. And to me, inherently within this, there is something about our monetary policy, because different types of monetary policy provide greater levels of financial capital. And sometimes they steer that financial capital towards one area rather than another. And I'm going to argue in this presentation that really since the mid-1990s, we've set up a monetary system following the devaluation of the renminbi, which created an ample supply of financial capital to gear up existing assets. But the same monetary system destroyed the return on lots of existing physical capital because of the undervaluation of the renminbi, because of the too cheap cost of capital in China. And therefore, this monetary system, which operated from 1994 all the way to 2020, was a monetary system which created too much financial capital, disincentivized investment in corporate capital, and undermined the very principle of value investing. And the result of that is that I think, as a top-down strategist, that we now have lots of cheap assets. I want to go on now to the fourth slide, which looks at Tobin. Once again, Tobin is not known as a bottom-up analyst, but Tobin came to the same conclusion. This is why he invented Tobin's Q, to help us with this equation between the supply and valuation of physical capital or intangible capital, corporate capital, and the supply of financial capital. And he did it to make his point by illustrating how that might work in the housing market. But this relates to all forms of corporate capital, physical capital. An increase in the market valuation of houses relative to current cost of building will encourage residential construction. The incentive is the gain to be made by the excess of market price over replacement cost. This profit is not wiped out immediately because construction takes time, and rapid construction is especially expensive, both for the individual builder and for the economy as a whole. In the long run, however, the increase in the stock will bring market value in line with replacement cost, lowering the former and possibly raising the later. Once again, there is this interaction between the creation of, in this case, physical capital, residential property, and financial capital. And of course, they can get out of kilter depending on which monetary policy we currently have in place. I wonder what Tobin would say if he could see Tobin's Q today. And we will look at Tobin's Q very soon, but I think many of you will know that it is at an astronomically high level for the United States of America. So the supply of financial capital changes depending upon the monetary system in place, and the nature changes as well. Is it debt capital provided by banks, or is it provided by non-banks? Remember, debt capital provided by banks, if it leads to an extension of bank credit, creates money. And money, depending on your opinion these days, also leads to inflation. And what we've lived with in the monetary system that has determined most of my career was a system where most of this financial capital was provided by the savings system in the form of non-bank credit. So it provided credit, it created credit, but it didn't create money. It led us to a world of low inflation and therefore low interest rates, but high provision of credit. This is abnormal. Well, certainly through financial history, it's relatively abnormal because prior to this, most of the credit provided globally in the credit system was provided by banks. And when banks provided credit, they created money. And there were inflationary consequences of that. But we devised a system post-1994 that didn't do that. A world of low interest rates, of low inflation, and relatively high growth is not the norm, but it's clearly a system which has vindicated a different form of investment from what we would call a value investment. At the same time, we have grossly distorted returns on corporate capital. Now, not all corporate capital. You'll be aware that there are certain companies listed in the stock market now with astronomical valuations that produce very high returns. But what happened in the mid-1990s is that China first, but then Korea, and I would argue Japan, got a massive competitive advantage through their exchange rates, which they undervalued. Not only did they undervalue these exchange rates, but they produced, or continued to run, I should say, a form of financial system that just kept feeding capital to anything that was adding productive capacity. And this is a societal and cultural thing, and I don't criticize it, but that is the nature of the system, and we'll come back to that. So it was a huge flow of cheap capital in North Asia, adding capacity and destroying returns for those businesses if they happen to be anywhere else. So now we've got two parts of that equation, that what I would call the value equation, the capital cycle equation, a proficiency of financial capital that doesn't create money and inflation, but at the same time, depressing returns on certain assets, many of which I think over the years came to be held by value investors because they did look cheap, but it depressed them on what we might call now a structural basis, given that this ran from 1994 all the way to 2020. So that's the system we live with. What happens if we go into a different system? We're now on slide 6. Now, this is the system that has existed, and it's best described, I think, by Paul Volcker. And how often does a value investor look at the global financial architecture? Well, I think this is one of those rare moments in history where we need to do it. Well, I'm not going to read this. It's there for you to read. But what Volcker said is we left a system of managed exchange rates, which was the Bretton Woods Agreement, with capital controls. We then went to a non-system where everybody was effectively floating. But from the mid-1990s, it was a do-as-you-please system. And anybody who wanted to link their currency to the United States dollar could do so, or to a basket of currencies could do so. And no bunch of monetary economists would ever have created a system like this, because it is so inherently unbalanced that some people link to other people float, capital moves freely. And I want to talk about the consequences of that hybrid system that's been running since 1994 to the current day, and why it's undermined some of the basic tenets of value investing and distorted the whole world of investment, and why that's coming to an end. So people often say, well, there's been no global financial architecture since the breakdown of Bretton Woods, but there has. It's the hybrid system, as described here by Volcker, and it's been a key cause of this distortion. We're now moving to number 7, which is the communal system. North Asia is not a world of free market capitalism. I'm not sure that such a world exists really anywhere. It's, we all live in a continuum, the free market capitalism, the command economy. But North Asia is quite closer to that command economy system. America discovered this in the 1980s in its disputes with Japan, but that system continues. And the undervaluation of the exchange rates of North Asia, and be clear here, I'm talking North Asia, everybody will focus on China, and I think rightly, because it's been the dominant force in North Asian business. But it's a system that pertains in Korea, to some extent in Taiwan, but not so much, and certainly in Japan. They're not targeting return on equity. They're targeting full capacity utilization. And so we've got two systems banging against each other. A battle which I suggest in my last book, people thought had been won by free market capitalism in 1998. They thought it had destroyed the crony capitalist system of Asia, but actually it didn't, and particularly in North Asia. So the system that North Asia has run, with an abundance of financial capital flowing to build ever more capacity, is the one that has destroyed anybody who's trying to compete with it on a return on equity, return on capital basis. Now, the consequences for this system, this undervalued exchange rate, which defended North Asia, was low inflation through import price deflation, therefore low interest rates, and more debt in the developed world as well. Once again, favoring corporations who had some form of growth and could gear up the balance sheet. In other words, a world perfect for the financial engineering that Volcker also railed against. That system, where we find a way for the communal system and the return on equity system to somehow get along, has created massive imbalances. And it's those massive imbalances that are unwinding today that we have to cope with. And they're not just unwinding in financial terms. They're unwinding in social terms, they're unwinding in political terms, and unfortunately, increasingly unwinding on the battlefield. The way we were trying to keep these two systems together, it's coming apart at the seam. I do want to read the quote on page 8, though, to give you some idea of this great battle that's been underway. And this is from the chairman of Mitsubishi Heavy Industries, which I took out of the Financial Times the day I read it on the 14th of January, 1998. And this is about Japan. Of course it is, but it's also about Korea, and it's also about China. And I want you to think, if it's about China as well, what it means for your portfolio if we stop trading with a China that runs this form of business cycle. So this is the chairman of MHI. For some time, I've been asserting that the business practices of Mitsubishi Heavy Industries put more stress on employment than on profits. We pay absolutely no heed to such concepts as ROE because they play no part in setting management targets. The main part of managing a manufacturing business is to use facilities and labour in a stable manner and at maximum capacity, and management tends, therefore, to focus on the volume of orders it can pull in. If we look likely to make more money than we were originally expecting, we take on orders at lower prices in order to adjust the figure. It is absolutely essential that our business practices take social effects into consideration and due controls are contained. Now, I'm not going to criticize it. That is the product of the social system of Japan. They have different social objectives. But the problem for the return on equity world is this is what it's been competing with, but particularly in China, which I would strongly argue has followed exactly the same mechanism. Now, it's easy to get distracted by the tech companies, which are entrepreneurial, doing different things, and we can leave those to one side. But the companies that were doing this were destroying returns for everybody else. And of course, the important thing about this presentation is it's over. If we don't trade with China, a large part of what I call the communal system is taken out of the system, and return on equity for everybody else will get a huge boost. And here we are. I did say we'd get to Tobin's Q, and this is the consequence. You'll see that something really peculiar does happen in the mid-1990s. We are somewhat in a range for the Q ratio. We also have the cyclically adjusted PE here, which I put up because we don't have the Q ratio for lots of foreign markets, but we do have CAPE for most markets starting roughly about 1978, given the MSCI data comes in 1968. So one can look at the level of CAPE and say it's a reasonable, somewhat proxy for Q, where you can see they have diverged recently. It's at an all-time high. And you can see how it seems to step up to a, shall we call it a permanently higher plateau? Because I'm here to tell you that it isn't a permanently higher plateau. But it seems to step up from the mid-1990s when China devalues that exchange rate, when we lock in that cheap exchange rate. And this categorically would say that the long-term returns from US equities will now be very poor. And yet I personally have more money in equities than I've had for many, many, many years. But they are mainly focused on value equities. Because within this, there's a whole set of equities which are likely to benefit from the new monetary system. So to be clear, the new monetary system that I'm about to propose to you, but we're now living through, it's begun, is called financial repression. In aggregate, it's bad for equities. But I strongly believe that there is a subset of equities, particularly value equities, for which it will be good. So Tobin's Q stopped working. Remember back to these comments from Keynes and Tobin, something happened. The arbitrage just didn't work. The whole idea was that at this level of valuation, we would see massive creation of corporate capital to take advantage of this and have that corporate capital valued at excessively high valuations. And it didn't work. And I'll show you later, this chart comes care of Andrew Smithers, another chart from Andrew Smithers. And after a little rise in the early 2000s, capital expenditure, particularly on machinery, plant, and equipment, has slumped, not just in the United States, but across the developed world, because China did it instead. And China did it with an undervalued exchange rate, but it did it at uneconomic rates backed by unfavorable or very favorable for them terms from the local banking system. And that is my proposition to you as to why value investing became incredibly difficult in this period, because of this distortion through this monetary system, because the arbitrage was suspended because of this bizarre financial architecture. So this is what happened after 1995, and this is why it's coming to an end. So we had the fall of the renminbi, which was locked in, the birth of this hybrid monetary system, but that was boosted by the Asian crisis. Remember, they also then began to lock in their very low exchange rates by September 1998. And then 2001, China joins the WTO, and it's even more difficult to compete with this incredibly cheap system, which is communal. It's not targeting the ROE, and it's getting very cheap debt finance from a banking system, which is also not targeting an ROE. And here are the consequences of the monetary system, which I suggest to you made it incredibly difficult to be a successful value investor. Massive central bank purchases of treasuries. So the whole yield curve was kept artificially low. Central bankers do not choose the price at which they buy treasuries. They choose the price at which they buy the currency. They then forced buyers of treasuries and euro bonds, euro government debt and other instruments as well. But they're forced buyers. They don't choose the price they buy. So they're non-price sensitive buyers, and they have depressed this yield curve, once again, to the benefit, I would say, of growth stocks rather than value stocks. The undervalued exchange rates and the overproduction and the overinvestment in China produced deflation and low interest rates, exacerbating that. But probably more important than anything, they convinced central bankers very wrongly, in my opinion, that the deflation that was coming from the East was very dangerous and it should be resisted. I do not believe it was as dangerous as they thought it was, but over and over and over again, because of the mistake of the 1930s, central bankers cut interest rates. And when interest rates reached rock bottom, they then begin doing quantitative easing, forward guidance, whatever, because they were so fearful of the deflation that could not have existed had we not been in this system. And that also helped financial engineering and growth stocks. But it's a direct result of the monetary system. Debt to GDP ratio has exploded across the developed world, suggesting again that a lot of the credit we've been creating, non-bank credit, has been flowing to gear up existing assets rather than to create these new corporate assets, which are at the heart of the arbitrage in the value investing business. As I said, the investment boom in China has destroyed key returns on many industries. And over again, we get more debt and less equity. In fact, the issuance of debt to buy back equity. So that's the consequences of this system that we've had to live with. And I'm arguing that that's why value investing has been difficult. I'll speed up now, just very quickly. Here's some of the evidence for that. This is going back all the way to 1950, better on a log scale, no doubt, but still gives you some idea of the scale of boom from the mid-1990s in foreign exchange reserves, all going into treasuries. And crucially, on the other side of that, central bankers' assets going up. That's what we see here. And on the other side of that, their liabilities, the commercial bank reserves they create in the process of doing this. And that's producing lots of cheap liquidity in these other markets for the banking system in the form of commercial bank reserves, and allowing them to fund all sorts of things which probably wouldn't have been funded in the developed world on the same terms, by banks at least, probably not even by non-bank investors. So there are two sides to this. One was that. So here's the consequences. Non-price sensitive buying of the key reserve currency, kept that key reserve currency overvalued, which didn't help businesses competing with China. Depressed the yield curve and interest rates, more beneficial to growth stocks than value stocks. Freed up domestic savers because the governments were being increasingly funded by foreign central bankers. It freed them up to fund other projects, and a lot of that was ending up in financial engineering. It wasn't actually building steel plants or shipbuilders because their returns were being depressed by China. We're now on page 12. And abundance of financial capital at low interest rates. On page 13, I just show US import prices, ex-petroleum, and you can see that they basically haven't gone anywhere since the mid-1990s until 2020. And this kept US monetary policy, but monetary policy generally kept it far too loose. For whatever reason, they feared the impact of import price inflation, and they kept interest rates low to combat that. This is not the monetary system we're going to be living in going forward, which is going to be much more inflationary, which I'll come on to. Page 14, I just show the consequences for the capital cycle from imported deflation, low interest rates, low inflation. Central banks panic occasionally when we actually get deflation, but also that imported deflation has crushed the returns of many stocks that look cheap, but then had to cope with this massive import of deflation. Page 15, the dreadful consequence of all of this has been soaring debt to GDP ratio. You can see way above World War II levels. And this is not government debt to GDP. It is government debt to GDP. It is household debt to GDP. And it is non-financial corporate debt to GDP. Combined total debt to GDP has reached record highs because it was so attractive to use debt in this monetary system. It wouldn't have been necessarily so attractive to use it before. We're looking at this chart telling us that different monetary systems the US has run, but we never saw anything like this. And you can see once again, something strange happens in the mid-1990s and it leaps up to a higher level. And that is the problem we're now seeking to solve. Here are the consequences of that. I think it's for financial engineering. It's encouraged people to gear up assets rather than build assets. It's encouraged the shrinkage in the amount of shares outstanding, which has been to the benefit, I think, more of growth stocks than value stocks as well. Now, crucially, through this entire period, that growth in debt to GDP shows you that the debt that's been growing really strongly is non-bank credit. The banks were not growing balance sheets particularly quickly during this period, and therefore they weren't creating money. If you don't believe me that commercial banks create money, there's a wonderful little article on the Bank of England's website that explains this. We're now on page 17 in terms of consequences for the capital cycle from the shift we're about to live through, where we've been funding everything or primarily funding it with non-bank credit. We're now moving to a world where we'll fund with bank credit. And that bank credit, read the Bank of England article, creates money and money creates inflation. So the world of low interest rates, the world of low inflation, which was a product of the old monetary system, is coming to an end. We're now on page 18, and this is I think the killer chart for the other part of the equation. A lot of this old system, we focused on the abundance of financial capital it created, which was to the benefit, I think, of growth rather than value. But this just focuses on the sheer pace of growth in Chinese fixed asset investment, growing well over 20% for most of the period post the mid-1990s, and its depressing effect on returns for anybody who was competing with it. First of all, you can see how that's been slowing quite markedly. But of course, my main point is that we're going to cut China off from the global trading regime, something I can maybe talk about in the Q&A, focusing here more on the capital cycle as to why China will be cut off. But when it's cut off, this overinvestment is ostracized, contained, cauterized, whatever, and we're now relying upon everybody else to provide these products and goods for the developed world. And that will be incredibly positive for that return on corporate capital, which has been depressed for so long. So we're getting two parts of the equation as we move forward. The returns on certain types of corporate capital go up, but the supply of financial capital comes down. The capital cycle is reasserted in favor of value over growth. Let's move quickly to page 20. So very quickly, this is the new system we get. We have to inflate away these debts. That's my opening proposition for the type of new monetary system we're going to get. The hybrid system is dead. How do you get rid of your debts? Well, you can go for austerity, as you see on page 20, but that is politically unpopular. I don't know anybody who's going to try it. Tried a little bit after the GFC, but was politically disastrous. You can default on your debt. The Bank of England thinks that will give you a 7% decline in GDP. And George, as you know, debt default, as we discovered in Greece, doesn't necessarily return you to a path of growth and prosperity. So I don't think it'll be default. These are all political choices, not economic choices. Real growth, yes, that's the way to do this properly, but we would have to have an incredibly high level of productivity growth if we are to reduce our debt to GDP ratio with real growth and low inflation. It's really highly unlikely, given our population growth and current trends in productivity growth, that we can manage that, but we can always hope. Mankind is wonderful, and it may invent something that can take us to a whole new level of productivity growth. We've got to hope so. Another way to get out of a too high debt to GDP ratio, remember that too high debt to GDP is a consequence of the old monetary system, Volcker's hybrid system. You could just hyperinflate it away. Possible, but dodgy, difficult, and dangerous. The consequences of hyperinflation are like roulette. You don't know where the political pain will necessarily fall, and there is huge political pain, and it's incredibly destabilizing. So that takes me to conclude that with a hybrid system now gone, we're going to look at repression. And the repressionary system is aimed at keeping the whole yield curve low while inflation is high. Now, it comes with a myriad of other policies, and I don't have time to go through all of them, but I can talk about that in the Q&A if you like. But that is a world where banks are important, government control of banks is important, government control of bank credit is important, higher inflation as a result of more bank credit and more money supply growth, and interest rates don't reflect that. And it's the antithesis of the system we've lived in before. And if it comes with this ostracization of China, which I strongly believe that it will do, then suddenly you've got a complete reversal in the capital cycle, a lack of financial capital, or at least a government controlling the supply of financial capital through the banking system to fund projects that it likes, and at the same time returns going up in those businesses that are competing with China. The page 21, just a quick scamper through some of those policies on the financial repression. Interest rates have to be kept below inflation, but think what that means. I mean, massive administrative interference to keep interest rates below, because none of us are going to lend our capital at rates below inflation in the long term. So we have to be forced to do so. And think of what that means for the listed equity market. It means forced selling. If the only way to keep the yield curve below the rate of inflation is to force savings institutions to buy bonds, you're forcing them to sell equities. And what will they sell? What they own. And what do they own? They own growth, and they don't own value. So there's now another force working here in favor of value rather than growth, because in a financial repression system, we're forcing people to sell equities, and they will have to sell only what they own. We are politicizing debt. That's the nature of the beast of financial repression. It doesn't flow for financial engineering. Financial engineering is seen as socially useless in this world. Debt is a prized thing, because remember, it can't grow anywhere near as fast as it used to. Nominal GDP growth has to grow higher. Debt can still grow, but much more slowly, because it has to come down relative to GDP. And we only do that by politicizing it and getting it to flow where we want it to flow. And it's already happening. Certainly in Europe, it's already happening in all sorts of ways. The governments are getting involved in the banks and forcing them to lend to all sorts of projects they wouldn't normally lend to. And we see that in Britain with a major loan going to Jaguar Land Rover from the banks, credit guarantee from the government. Emmanuel Macron has launched a new industrial policy from France, which will be financed by the banks, guaranteed by the government. So the one thing to me that really flags up that we're in a new system is government credit guarantees of bank lending, which is allowing the government to politicize bank lending, and therefore the government is in control of monetary policy, not the central banks. Now, if this credit is politicized, it will flow where the government wants it to flow to, and I'll come back to that in a minute, because that is probably where, as an equity investor, you're going to make your best returns. Now, in the long run, a massive supply of financial capital to any business will create the corporate capital, which undermines returns, but that is the long run. And in the short run, many of the businesses which are considered to be in the value sphere are exactly the things that the government wants to be financed. So we have to make other assets less attractive as well to try and get people to buy all these government bonds. And that can be rent controls, transaction taxes, even dividend controls. So page 22, so we'll have less buying of government debt by foreign central bankers, therefore more by savers. savings institutions will be forced to sell other assets to buy government bonds, but they can't sell what they don't own, value. Inflation rises as bank lending needs to expand. Why pay for a moat? The definition of inflation is that everybody puts up prices. Do you really want to pay a premium for a moat to allow pricing flexibility? You wanted that in a disinflationary environment, but do you want it in an inflationary environment where everybody can put up prices? Is it worth the premium? Bank credit becomes a key source of finance, which means we have to cap the flow of non-bank finance. I think financial engineering comes to an end. Interest rates are higher under the hybrid system than they were under the hybrid system, but they do not get anywhere near the rate of inflation. And fundamentally, credit and savings are increasingly directed by the state and not by the private sector. And for those of you who think this is just some sort of cloud cuckoo land, this is exactly what we did after World War II, when our debt to GDP ratio was lower. Not for the governments, certainly the European governments, but certainly in aggregate, it was lower. Looking at page 23 for corporate capital, less competition from China, producing higher returns. The quality of capital allocation by those who survive is revealed. It's been very easy to criticize these corporations for years, but they've been competing with an undervalued exchange rate and a communal system that has got a very low cost of capital and doesn't target return on equity. So, of course, they've struggled. And when we begin to lift that yoke from them, we'll begin to realize that they've actually been quite good at allocating capital. There's been a generation of underinvestment in these corporate assets. That's where you get the highest returns. The old system starved these industries of financial capital. They underinvested. And now as the old system ends, these are our key assets that get good returns going forward. The cost of capital will remain low if you're seen as a strategic corporation going forward. Steel, shipbuilding, chemicals, all the things that migrated to China are now the things that we need to rapidly reinvest in. If you don't believe me, listen to Janet Yellen from about 4 days ago when she talked about friend shoring. You may never have heard of friend shoring. I'd never heard of it until 4 days ago. But friend shoring is the principle of which all of the capacity that was in China, she almost specifically mentions China, not just Russia, has to come back to friendly shores. And that means a massive capital expenditure boom. So there will be a re-equitization for the corporations that can no longer access cheap debt, and I would argue those involved in financial engineering are the key players here. They will have to re-equitize. So you have a horrible situation where finally there's a greater supply of equity at the same time that you're forcing savings institutions to sell equities to buy bonds. That is not good for aggregate valuation of equity, but it's not bad for value equities if they're under-owned, getting cheap finance from the state because they're seen to be in strategic industries. Consequence is a great capital expenditure boom to fund the national security emergency, to fund an energy diversification emergency, to fund the climate emergency, to fund an inequality emergency, a wage emergency, but most importantly, a China emergency. And that's the bit people are getting wrong about all of this. They don't fully understand where the growth is coming from, because the growth really hasn't come from capex for a long time. So now it's going to come from capex. I'm just going to leave that up on the screen, George, for people to look at. This was the last great long bear market. As you can see, consumer price index up 196%. Large cap stocks with dividends reinvested up 126%. Large cap value 250. Mid cap value 352. So there can be long bear markets in equities where you can make money in real terms in equities. And the last time we did it, it was in value stocks. George, apologies for the technical problems, but I hope that you could follow that. That's the end of the presentation.
Maybe I'll ask a last question, Russell. I was looking at your CAPE and Q ratio chart, and I couldn't help thinking, I guess, because I've been thinking about this for some time now. If you look at the level of CAPE and Q before 1914, when because from the 19th century on to the First World War, we had globalization. And then after the war, we had deglobalization. And this remained until 1991. So what I saw was like the CAPE and Q were high before 1914. They remained low and stable until 1991. And then it jumped with the new globalization after the fall of the Berlin Wall and the breakup of Soviet Union. And the question is, and I mean, I'm getting the sense that you believe there's going to be deglobalization coming up soon, if you're not already started. You talked about, China cut off from trade. I think maybe Russia too. So do you see deglobalization and the effect, I guess, of value versus growth stocks? Because it seems that growth stocks benefit from globalization, and I think probably value stocks may benefit from deglobalization.
So the simple answer to that would be yes. I hope you've got it up. It's page 9 if you are getting it up on the screen, of the Q and the CAPE ratio. So I would, two things after World War II, George: globalization and financial repression. So if we're looking at the chart for the United States of America, it doesn't really have a lot of financial repression until the late 60s, early 70s, when it's hit by the oil shock. And it goes for wage controls, price controls, capital controls, basically interest rate controls. That's when it really goes for the repression. And you can see the slump in valuation that follows that. Valuations hadn't got to such elevated levels elsewhere. So I look at the post-World War II period as well. We can look at the free movement of trade in that period and globalization, but you can also look at the free movement of capital. And particularly for non-US countries, there was no free movement of capital. Now, there was for the US, but it began to wither with the interest equalization tax of 1963 and got much stronger with Johnson, and then finally with Nixon. So that period, I think, George, we could talk about that period for a long period of time. So it's a lack of globalization, it's financial repression, it's more government control. And those are exactly the things that we should be forecasting today. And I think in our heart of hearts, we all know they're coming. And you're right to point out that on the whole, it produces a lower valuation. In many ways, things are worse now, George, because if we look at the debt to GDP ratio for the United States of America, where it was, and this is on page 15 if Ben's moving the charts, you can see that when we went through that last repression, and certainly, debt to GDP in America was about 130%. And now it's 281%. So I would argue that actually it has to be bigger. The repression we need today is actually bigger than it was. So yes, I definitely see deglobalization, but I see financial repression internally as well. And the consequence of that, I think, is much lower equity valuations. But as you say, George, and hopefully I was clear about this, there are a lot of companies that will do exceptionally well from reshoring, friendshoring, capital expenditure booms, and cutting off supply from China. So the bizarre conclusion is it's clearly bad for equities in the aggregate, but I think you have to be in equities, but it has to be more at the value end of the spectrum.
One more question, I guess, from Elena, and then we'll go to a break. Elena?
Yes, we have one more question from an attendee who asks, how do you see India factoring in, given your view on China and the friendshoring dynamic?
So I've been very positive in India for a very long time, particularly on the economy, more than the stock market, which also appears to be overvalued. But India is the clear winner in this geopolitical shift. We know that India is playing hard to get, but that's all it's doing. It's not in any way in doubt which side of the line India will come down on, but there are lots of people in powerful positions now to argue for good deals in terms of the New World Order, and the Prime Minister of India is arguing for that. So the friendly shoring policy enunciated by Janet Yellen just a few days ago will favour many, many countries in the world, but India will be one of them. India will have a problem with too much capital flowing into it. That's a nice problem to have. The Indian Central Bank has been incredibly conservative during COVID in terms of the size of its balance sheet, the amount of growth in broad money it's permitted. And therefore, I think India will be incredibly, the Indian stock market will benefit incredibly from this. But once again, a shift in India to a different type of stock potentially. And this reshoring is really going to be a great driver for India. So in 2006, I wrote a piece for my clients comparing India and China, and it said, buy chaos, sell order, suggesting that in a capitalist system, order imposed from the top is dangerous, gives you the wrong price messages, distorts capital investment, and destroys returns for investors. And buy chaos, which was the chaos of India, which I realize is insulting to some Indians, but the point was from the chaos was forming a new form of order, which would be very good for returns on capital. I see no reason to change my mind on that structural call. And India is in a very good position in what is frankly a very frightening and dangerous new world order.